All right, today we're going to tackle a topic that sounds super complicated, but I promise you, it's actually built on a few really simple ideas. We're talking about options trading. Let's break it down.
So, to really get this, let's forget about stocks and Wall Street for just a minute. I want you to imagine something. What if you could bet that a certain pair of sneakers is about to become the next big thing, but without actually having to go out and buy them? Just think about that. That's the core idea we're going to play with.
Okay, so let's run with that. Say your friend has those sneakers, right? They're worth about $100 today, but you've got a hunch they're about to blow up in price. So you go to your friend and you make a deal. You pay him, say, $5. And for that $5, you get the right, and this is the key word, the right, to buy his sneakers for that $100 price anytime in the next month. Now, you don't have to buy them, but you can. That little $5 fee, that's what we call the premium. And the deal itself, well, that is an option.
Okay, so we've got the basic concept down, but what can you actually do with one of these things? Well, it really just boils down to two very basic bets. You're either betting the price is going up, or you're betting it's going down. That's it. That's the whole game at its core.
And, of course, these two bets have names. If you're betting the price is going to go up, you're dealing with a call option. Think green, think go. And if you're betting the price is going to go down, that's a put option. Think red for a drop. Up or down, call or put. See? Simple.
Let's circle back to our sneaker deal for a sec. That was a perfect example of a call option. You paid for the right to buy at $100 because you were betting the price would shoot up. And guess what? You were totally right. The sneakers are now worth $150. So use your option, you buy them for that locked-in price of $100, and boom, you've made a profit. That's a call option in action.
Now, a put option is just the flip side of that coin. Let's change the story a little. Imagine you already own the cool sneakers, but now you're getting nervous. You think they're about to go out of style. You can actually buy a put. You pay $5 for the right to sell your sneakers for $100, no matter what happens to the price. So if the price crashes down to $60, you're protected. You still get to sell yours for $100. You bet on a drop and you won.
All right, now we're getting to the part where a lot of people's eyes glaze over. We're going to talk about a few scary-sounding Greek words. But please, don't tune out. I want you to think of these not as some crazy math formula, but more like personality traits. They just describe how your option is going to act.
First up is delta. This one's the most straightforward. Think of delta as your option speed. Simple as that. If the stock itself moves up by $1, delta tells you exactly how much your option's price is going to move. So if your option has a delta of 0.50, that means for every $1 move in the stock, your option's price moves about 50 cents. It's the baseline speed.
Okay, so if delta is the speed, then gamma is the acceleration. It's the turbo boost. Gamma measures how quickly your speed, your delta, changes as the stock keeps moving. So when a stock really starts to take off, a high gamma means your option's value can suddenly just accelerate. It starts picking up value even faster and faster.
Next up is theta, and this one is so important. The best way to think about theta is to imagine your option is a melting ice cube. Every single day that passes, your option loses a tiny bit of its value, even if the stock's price doesn't move an inch. This daily decay is theta, and it means for an option buyer, time is literally the enemy. It's always ticking against you.
And finally, we've got Vega. I love this one. Think of Vega as the hype meter. You know how sometimes everyone gets really excited about a stock, like right before a big earnings announcement? Everyone expects a huge price swing? Well, all that excitement actually makes the options more expensive. Vega measures how sensitive your option's price is to this level of hype. Here's a perfect way to think about it. When there's a big storm on the forecast, what happens? Everyone runs out to buy umbrellas, and the price of an umbrella skyrockets, right? But when the forecast is clear and sunny, umbrellas are cheap. That is exactly how the hype for an option works.
So that hype, or that storm forecast, has an official name. It's called Implied Volatility, or just IV. Now, the key thing to get here is that IV is not a prediction of which direction the price will go, up or down. It's the market's collective guess at how big the move is going to be. And just like those umbrellas get super cheap the moment the storm passes, when the hype dies down after a big event, that's called IV crush, and it can drain the value from an option really fast.
Okay, we've covered the personality traits. Now let's just quickly go over the basic rules of the game. These are the key terms you're going to see on every single options contract you ever look at.
Every single option has two main rules. First, the strike price. Super simple. That's the locked-in price you agreed on. In our story, that was the $100 for the sneakers. And second, the expiration date. Just think of this like a concert ticket or an airline ticket. After that date passes, it's totally worthless. It just disappears.
So, right now, at this very moment, is your deal actually valuable? Well, if the stock is trading at $150, but you have the right to buy it at $100, your option is in the money. It has real, tangible value. But if the stock is down at $90, your right to buy it at $100 is kind of useless, right? At least for now. That's called being out of the money.
Okay, we've gone through all the individual pieces of the puzzle, the Greeks, the rules, now let's put it all together. This is the big takeaway, a simple rule that really governs everything we've just talked about. When you boil it all down, an options price is really only being pushed and pulled by these 5 things. First, the stock price itself. That's our delta. Second, time just passing by. That's our melting ice cube, theta. Third, the excitement level. That's Vega and IV. Fourth, how fast it's all moving. That's our turbo boost, gamma. And lastly, interest rates, which honestly is not something you really need to worry about when you're just starting out. And this all leads us to the ultimate simple rule of the game. It's basically a tug of war. The person who buys the option wants a massive, fast move to happen really soon with a ton of hype. But the person who sells that option, they want the exact opposite. They are betting that absolutely nothing happens. They just want time to pass by quietly and for all that excitement to just fizzle out.
So look, if you only remember one single thing from all of this, let it be this definition right here. At its heart, an option is just this. It's paying a little bit of money for the chance to win a lot. If, and only if, something big happens before your time runs out. That's really all it is. Simple, right?